Okay, fantastic. Okay, good morning and good afternoon to some of you. Welcome to the Daily Energy Markets podcast. I'm delighted today to be joined by Ole Hansen, Head of Commodity Strategy at Saxo Bank, Yuri Humber, Founder and President of Japan NRG Platform and the Yuri Group, and also Janiv Shah, VP of Oil Markets and Downstream Analysis at Rystad Energy. Thanks so much, gentlemen, for joining us. Ole, let me go to you first and get your take on where you see the markets heading in the next month or two. We had a bit of news this week with OPEC unsurprisingly extending their cuts into Q2. Do you think that's enough of a statement to make at this stage? Will that support prices above $80, which is a question we put to our viewers earlier this week, beyond June, through to June, but how about beyond that, in your opinion? And where do you see the direction of the market going in general?
Well, good morning. Well, I think it's safe to say that these markets have become relatively boring. I think that's probably a good thing. We don't like too much volatility, and that's most certainly not what we're seeing right now. March is only just begun, but we're heading for the lowest trading range in Brent since September 2020. That's obviously a reflection of, I would say, of OPEC Plus's success in managing to keep prices supported during a troubled time at the start of the year, and since then the underlying fundamentals seems to have picked up a bit, and we also still have the geopolitical risk that's ebbing and flowing in the background. So overall, I don't think there's any much reason to change the outlook, which is still range bound around 80. If you look at Brent crude, still struggling to break above 85. And when we move deeper into the year, we saw the quite optimistic growth targets from China overnight, 5.5%. If that can be reached, that will obviously should point to continued strength in demand in China, and that will also help the situation. But at the same time, we're starting to see a bit of weakness coming into economic data from the US. So overall, I think cuts probably will be extended for the foreseeable future. They will start to try to taper them back, but that's always a difficult exercise because the demand really has to be strong for that to happen. Otherwise, in order to avoid the market sell prices seldom sharply lower. So the strength in the market really has to be there before they can start contemplating making any cuts. And we're probably not going to see this, and that potentially could lead to an extension beyond June.
Okay, thanks, Ole. So I mean that stat that you put out was lowest trading range for a few years, and that's despite all this geopolitical potential escalatory turmoil to happen. So that does indicate, Gianni, if I can go to you, that we have abundant supply. No one's panicking. But what about what you're seeing in terms of potential further disruption because of the Red Sea flow change of direction that we're already seeing, and how is that impacting the outlook for products, both crude and refined?
Well, firstly, thank you for having me on today. This is a pleasure indeed. I think, it would have to agree mostly with what Ole just mentioned. There's a significant amount of crude on the market. This is partially due to the non-OPEC plus supply extending. We've got year-on-year growth in the US for crude and condensate around 400 to 500,000 barrels a day, as well as what's coming out of LATAM, which is sort of around 600, which is spurred on by the Guyana, production and then therefore exports. I think, going into Q2, the market does seem, it's flipped back into more of a deficit, agreed. And this is partially due to the number of new refinery capacity projects that are coming online, as well as existing capacity extending and ramping up just partially in Northern Hemisphere in Europe and the US due to summer travel and summer demand season extending. I think moving forward with this Red Sea disruption, this could take many months to solve and to resolve. So there are, shipping or vessel or freight timings that have been extended and are foreseeable, to be extended even further. So, extension of this requires extended timings and obviously extended fuel, VLSFO or HSFO for products. Now, coming into the European storyline here, if this Red Sea disruption does continue, the amount of crude coming into Europe, of course, is impacted. But importantly, what's coming in terms of diesel and imports from Asia is to be impacted further. And we will see, as per our estimates, if current levels of imports from the Asian region continue, and European demand continues to grow and ramp up from diesel and jet, we're seeing yields of diesel and jet increasing by 50. Well, for diesel, firstly, 45 to 50% between now and what it should reach, as well as jet increasing from 8% currently to around 12%. So both of these really do spell some trouble for Europe moving forward, as these both can't, be optimized for at the same time, considering European capacity and the level of complexity that Europe has. So we do see cracks in Europe potentially spiking up. And this is to continue, of course, with the unplanned outages that we do foresee.
And where is most that product supply that's going to spike in yield coming from into Europe for jet and diesel?
Well, we do see the US as a potential source point. If the US runs do recover, we've seen week on week muted runs numbers. However, moving forward, the US has potential outlets. Maybe as Dangote in Nigeria ramps up, that could be a potential rescue option. But I guess the Middle East really does provide, and then Asia really does provide the answer to Europe's tightness.
Okay, thanks, Genevieve. Yuri, welcome. Give us, you're sitting in Japan. Do you feel relatively immune to everything that's going on here in the Red Sea and these sort of product flow diversions? I mean, from an oil and gas point of view, give us the projection there. Also in the context of, what's your feeling in terms of Japanese economy recovery and perhaps a new confidence there?
Thanks very much, Jelva. And then obviously there's a few things to address there. First, I would say that, Japan hasn't been strongly impacted so far by the outbreak by the conflict in the Middle East. But that's not to say that there isn't a great deal of concern here about potential impact. So one of the Japanese ships did get essentially boarded at the end of last year by the Houthi rebels. However, I think what's interesting is, on the one hand, Japan is actually easing on its imports of major fossil fuel commodities. So January imports of crude oil were down sort of around 14% year on year. For LNG, we were down about 10 or 11%. Similarly, similar numbers for thermal coal as well. That's not to say that the economy has massively sort of switched in all of a sudden to non-fossil fuel energy alternatives, although there is obviously a growing influence of nuclear restarts playing on the import picture. But I would say that there has been a steady progressive ability to improve energy efficiency in the economy over many I would say the last decade. And so even in addition to the weather factors, in addition to the decarbonization story, etc., Japan has been quite successful in reducing its total energy efficiency and therefore the energy imports. That has finally translated into some of the big wins that we've seen recently on the economic front. So probably some of the headlines that people are familiar with are, the Nikkei stock averaging finally beating its sort of something like 40-year record, and hitting the highest ever level of 40,000 just in the last couple of days. You've got the yen in a 40-year low against the US dollar, which is giving some boost to exports, of course, although is, on the contrary, is hurting the ability to import some of the crude oil and LNG. But I think one of the other major stories, and this is really what's propelling the stock rally in Japan, has been the arrival of the big semiconductor companies to Japan, such as Taiwan's TSMC. So they are starting to open factories and planning to open more factories in Japan. And I think that's going to really increase the energy intensity of the economy. So in that sense, I think that, you know, maybe in a couple of years and later down this decade, we're going to see Japan come back as a much stronger energy demand story.
Okay, thanks, Yuri. That's interesting. So that's part of the relocation from China. Is that sort of part of that trend?
The semiconductor, well, I mean,
Yeah.
obviously, a bit is the geopolitics for sure. Some of the Taiwanese companies are looking for alternatives, not just in Japan, of course, in Europe, also in the US. But it is also the commitment that Japan's government has made to reviving the semiconductors sector in Japan and trying to essentially, to play that role as a close ally with the US to develop new technologies that would be able to shift, at least make the US supply chains less reliant on Chinese economy.
Yeah. Very interesting story there, dynamics. Ole, thanks very much, Yuri. Ole, back to you. Let's get a bit of a picture from you on what your expectations are for sort of the monetary side of things. We've got the Fed chairman in front of Congress tomorrow. We have the ECB rate setting on Thursday, and give us expectations on that front, which we could read about. But how's that influencing perhaps the funds that are in and out of this oil market? You know, are we expecting them to get a little bit more bullish as time goes by?
Well, deflation is most certainly the word to use in terms of expectations. We have spent the last couple of months just scrambling to deflate expectations. They have been lowered now to a level which I think is probably reasonable. We are in the 3 to 4 rate cut ballpark in the US, a little bit higher in Europe. But the problem is obviously the timing of the first and the depth of the subsequent cuts, simply because we have a US presidential election. So the window of opportunity for the Fed to cut rates this year is much narrower than what otherwise you would expect in a normal year. So I think at this point the market is probably priced in more or less the number of cuts, and I think from here on any economic negative surprises will lift that again, and that will bring back some speculation that they may have to go in half points instead of quarter points. But the market is not ready for that yet. And economic data is still bumping along, but there are some underlying signs of some weakness, and it's obviously a problem for Europe because we need to wait. Or at least we will try to wait until the Fed starts kicking into action, and we actually need the lower rates now because economically we are not as doing as well as the US at this point, and I think that's a general problem around the world, that the US economy is simply surprised, and as they are the trendsetter in terms of rates, we're potentially seeing a rate cut delay, which is not justified by the domestic economic situation. So it will be an interesting one to follow, but obviously the market wants to avoid any major movements in the currencies if we start to cut rates first. Yeah. So the market is. I think we probably reached the lowest level in terms of expectations for cuts, and from here on potentially could be a surprise that the market will have to price in more cuts than what's currently priced in. And you talk about speculators in the oil market. It's not really having such a big influence. It's more in the metal space where the financing of holding bullion, holding industrial metals is still very high, and until we start to see rates come down, only then we'll really start to see some prospects for restocking. Not that it has prevented gold from reaching a record high, but at least industrial metals will have to wait for the funding cost to start to come down.
Okay, so that's what's been sort of pushing and the base metals down. Then it's the financing costs of getting into those, essentially. That's what's kind of brought that down.
Yeah, simply restart.
Not fundamental demand from manufacturing centers around the world.
It's been a combination of both, because with the rapid increase in rates last year, whoever held industrial metals, and they started to offload those simply because the cost of financing was going up. So this destocking process that we saw last year will eventually turn to a restocking phase. But until we start to see funding costs start to come down, then that will take some time before it plays its part. So probably one of the reasons why industrial metals as a whole has been struggling. Not so much copper, that's a different story. We all know the green transformation story there, but generally they have been struggling with these high funding costs.
Thanks, Ole. Johnny, I mean, let's talk a bit about manufacturing in a way. A bit about China, because I wanted to come back to you on sort of product flows. China, yes, it's set its new 5% growth target. It's still announcing a couple more things today, I believe, on the economic plan for the year ahead, stimulus measures, etc. But also what we had a couple of months ago was that the government set the quotas for exports and crude imports, I believe, for China for the year ahead. Now, is that a positive thing for the volatility side of product flows out of China, let's say, into the rest of Asia, or not? And how would houses like yours be looking at that?
It's a good question. I think the quotas being set for the full year for both crude and products essentially has tapered off some volatility within China. Now refiners can choose when and how much to import and export as per their processing, as well as maintaining their run rates on an overall level, independently of how other maintenance cycles may run within other refineries within the country. There's an important factor here is that the growth has been is reduced down to sort of 1.8 to 2% for year on year, and that's left our Chinese runs numbers, just a small, I'd say, relatively small number in terms of growth, around 400,000 barrels a day. What that does, though, is of course allows the importers to import and exporters to export into the rest of the region, but also provides some rescue option, as I mentioned earlier, for Europe. Now, with Chinese runs, there is a significant amount of new capacity coming online. However, these projects could potentially be delayed to coming into Q4. We're looking at a 400,000 barrel a day Yulong refinery, which is integrated petrochemical in the Shandong province. This is on top of what has come online recently in the form of multiple large refineries, Jieyang and a couple of others, around 300 to 400,000 barrels a day. So overall, Chinese runs, we do see strong amounts of maintenance, but some maintenance has been deferred coming into the end of Q1 here because of how strong cracks and margins have been through the whole first quarter of this year.
Okay, thanks, Johnny. Yuri, back to Japan. Let's talk a bit about gas and gas demand, because we've had obviously some movement on prices there globally. But just generally speaking, in terms of LNG demand into Japan, last year we had a slightly volatile picture. Has that sort of stabilized in terms of stocks there? And also give us an update how that's impacted by the restart plans of the nuclear reactors that is sort of ongoing.
Yeah, sure. I mean, I think Japan was well known for many decades as the world's largest importer of LNG. And well, last year, China, I think again, for the second time, overtook it. So Japan's now the number 2. But I think the bigger story is that Japan has essentially reset its LNG demand picture to what it was before the Fukushima nuclear disaster. So last year's imports were down by, I think almost 10%. And that was essentially due to, again, nuclear restarts being one of the issues. But, it can't be the only explanation, because if you look at the size of the nuclear fleet online right now, it's about 10 reactors. The size of the Fukushima, the size of the nuclear fleet at the time of the Fukushima disaster was, 3 to 4 times bigger. So not only are we talking about nuclear energy coming back online, but not being at the same level as yet. I think we have to look also at the other factors, such as, again, what I mentioned earlier with energy conservation, obviously the impact of renewables, which are eating into the into the market share for LNG. And while I think for a while, the LNG and natural gas will still be very much in demand in Japan because of the desire to reduce coal use. I think towards the end of this decade, we are going to see the coming into prominence of ammonia, at least as a co-firing option at first, but with the idea that sometime during the 2030s, there will be single firing ammonia. Once we move towards that, or hydrogen firing, I think it's possible that that will start to eat into LNG demand into Japan.
Thanks, Yuri. Okay, there's our question for today, which is about the Red Sea area, the trade, the crude and refined products that pass through there, around 7 million barrels a day, 12% of the world's total seaborne trade through the Red Sea. Will we see more price volatility this year if the current disruptions persist? Yes, we will start to see that not only in spreads, but flat prices as well. Or no, that's not a big enough volume anyway to have any major impact, seeing as it's making its way to its destination eventually. So let's vote on that, and we'll get those results later. Ole, let's talk a bit about Russia and Russian flows. We had a slight, stricter sanctions put on some of the Russian flows towards the end of last year, some more earlier this year, primarily expected to impact shipping per se, and Russian ships, insurance, etc. Are we seeing any impact from that really? Can we still safely say sanctions are not really disrupting eventual consumers getting that Russian product?
I'm not a major specialist on flows out of Russia, but what we I think we're seeing so far is that simply that if there's a buyer, there's a seller, and Russia is obviously a willing seller of its products and its crude, and the buyers have been found so far. The transportation is as you mentioned, something that is receiving more attention, and there are some signs that some shippers are holding back or getting out of the business simply because they've been found out. But overall, I think as long as there's a buyer, then there's also then the oil and the product will find its way through to the market. We did see those additional cuts announced by Russia at the weekend. It's mostly just, I think, more to do with domestic production and domestic demand management, leaving them the window to add some additional cuts to the existing, and obviously to make sure that everyone stays happy within the group while they keep these curbs in place.
Yeah, and we'll I suppose the group will have to prove itself, won't it, in terms of compliance month on month, and then we'll see what happens to June to those quotas. Thanks, Ole. Genevieve, you mentioned at the beginning about LATAM, US non-OPEC, essentially, production. We've had quite a few comments since the sort of peak records, surprise records in US production were reached at the end of last year, and two schools of thought, it seems, going forward. Yes, we're going to see kind of more of the same as we did last year, and others are saying no, that was just an exception, and indeed, in fact, shale oil is going to plateau. So what's your sort of sentiment of what you're hearing on that front?
Yep. So speaking with the team here, and our shale team, I believe growth is tapering off. We are unlikely to see extreme growth like we did through 2022, 2023, but 2024 is more of the 500,000 barrel a day or just under. Now, most of that growth we believe is of course going to be light sweet US WTI, but most of this will be coming from the Permian as opposed to other basins or regions within the US. The important factor here, though, for the overall crude market is with this light sweet US grade, this production coming online, it's not the exact type of the barrel that the US needs in terms of its refining system. It needs for its complex refineries to cut down in the Gulf Coast, more of these medium sours and heavy sours to process and produce these middle distillates, primarily where the growth is with gasoline, diesel, and jet. However, for this to happen, current sources of these sour grades, coming from Canada, Mexico, Venezuela, and a few others within just the Americas, are going to be under pressure in terms of how much can come into the US. You've got the TMX pipeline, extending flows towards the west from Canada. So essentially the east and the flows out into the rest of Asia. Within Mexico, you've got Pemex's Dos Bocas refinery coming online and taking a lot of that heavy sour Maya grade offline. So it's primarily down to how much the US can produce for the heavy barrels, but also how much Venezuela can potentially produce moving forward. But of course, all of these have economic considerations, and we're coming into 2024, the big year of elections. So multiple new geopolitical factors that we also have to consider. As nobody, I don't think many want to lose power, whoever's in power, and primarily force anything against a recession.
Thanks, Jean-Yves. Yuri, just back to you briefly on delving a bit micro into Japan's electricity market and pricing there. I mean, last year we saw a couple of announcements that there was quite a sort of jump in domestic electricity prices for households, different reasons behind that. Where do we stand this year, again, in the kind of light of the economic sort of more positive sentiment that you described earlier, and is that a stable market now for the Japanese consumer?
Electricity prices have been surprisingly mute. I mean, a little bit how Ole described the crude oil trading earlier. They've become a little bit on the boring side in the sense that they are, again, that they're sort of back to single digits per kilowatt hour in terms of yen. However, that is mainly talking about the sort of the wholesale market. There is a great sort of downside for the Japanese consumer with all the sort of the positive economic factors that I described earlier. The yen being at such a low level means that naturally, even if the crude oil prices stabilize and the natural gas prices stabilize and decline somewhat, Japan is still paying quite a substantial amount more. I mean, the yen is 150 to the dollar right now, and say 5 years ago, it was about 100 or 105. So you can imagine that has filtered into the electricity costs. And because of the delay mechanisms that essentially don't allow the utilities to pass on the rising fuel costs immediately, the households are still essentially catching up with the increased prices from sort of last year and before. I would say that at this moment, what is probably the positive story in terms of electricity investments or trading is the fact that volumes on the spot market, volumes on the futures market, and so forth are setting records almost every month. So that's why we're seeing major companies like Vitol, like BP, and Goldman Sachs, and so on, really joining the Japanese electricity market. So as an investor, it's a great time. As a consumer, maybe not so much.
Okay, thanks, Yuri. There's the result of our question, quite close, but a few more people saying that flat prices and spreads will increasingly reflect these flow diversions. We're going to wrap up now, but Ole, just back to you for last comments on, whether you think that this year we'll see, this divergence of sort of demand expectations. I mean, they're all projections and forecasts. Nobody can tell, of course, what demand's going to be. So many factors playing into that this year, from geopolitics to economic policy to how these economies are going to do in China and the US. But why then, therefore, would we still be seeing, possibly these diversions in demand expectations? Is it that OPEC and IEA, et cetera, are talking their own book, or should we expect to see a narrower range of forecasts this year because things are a bit more predictable?
Oh, that's a good question.
I mean, is our demand projections more settled now that we know what China's up to, et cetera, as well?
I think they are more settled, and again, obviously, OPEC and IEA, both, they're talking their books, so it's probably somewhere in between that we'll find the right number. But I think they have settled down. I think and what is obviously worth noting that the growth is still expected to be obviously still expect to see net growth in demand, and that's not going to disappear anytime soon. Even though obviously we will see slowly the green transformation erode some of the demand, but potentially. The jury is still out whether that will happen as fast as the IEA is expecting. So yeah, demand is narrowing down. I think the uncertainties that lays in front of us is still how China can achieve that 5% growth target. Whether we're going to see some weakness in US over the coming months, and then simply when we can get these rate cuts started in order to stimulate growth. So probably still some volatility, but seems like we're settling down here.
Yeah, it feels like by mid-year we'll kind of have a much clearer picture as to how the rest of the year is going to go. Thanks so much to Ole, Janiv, and Yuri for joining us this morning, and look forward to seeing you all tomorrow. And have a great remainder of the week. Thank you.
Thank you.
Thank you.